alternative way if you don't want to go through the traditional way of obtaining a mortgage from the beginning. So what is this other way you can actually become a homeowner without actually just going to a lender and getting a mortgage? So it's called owner financing, or some people may call it seller's financing. So what is owner's financing or seller's financing, right? So owner's financing is a real estate agreement which the property seller acts as the lender and provides financing to the buyer. So the buyer really don't have to go to a lender because the seller will act like their lender. And why would a buyer want to go to a seller instead, right? This buyer might not be able to qualify for the traditional financing due to maybe their credit score, or maybe they're unable to come up with down payments, and they don't qualify for other options that don't actually require a down payment, right? But they're still willing to actually go for a house, or however become a homeowner, so they can choose to do the seller's financing. So the buyer will actually be paying their rent, or sorry, their mortgage to the seller instead of paying it to the bank. All right. So that's just how it is. But you're still gonna pay regular payment. There might be interest rate on it, just depending on how much you guys are agreeing upon. And you guys are going. You as the buyer is going to be paying all these monthly payments to the seller until you finish paying it in full. So how does this typically work? So first it's going to be both the buyer and the seller, which is going to of course be the lender, have to negotiate the terms of what they want on this contract, right? So the buyer and the seller negotiate the terms of the owner's financing agreement, and this includes the purchase price, the property of purchase price of the property, the down payment if there's gonna be any. Doesn't mean you might not pay for down payment. They just might, depending on who it is, agree to you for you to pay some down payment or not. So it's not gonna be the same for everybody, okay? Keep that in mind. And interest rate. So the interest rate is gonna be how much the seller wants the interest rate to be, however. So if there's gonna be interest rate, it's gonna be in this agreement. And the duration of the loan. How long will the seller want to be patient for you to be paying them? Or how long will the seller want to be your lender, right? And what is the payment schedule? How much are you going to be paying a month to this seller, which is going to be your lender at the same time? Okay, so that's going to be the first thing, which is going to be you guys negotiating the terms of this contract. The second is going to be the purchase agreement, and the purchase agreement is just what the contract deed is going to be drawn up for. So it's going to include everything that is going to be negotiated in the terms, and it aligns what conditions the owner financing wants, includes the details of the property and agreed upon price and financing terms. Okay, so this is just what agreement is going to stipulate everything that you guys had negotiated on the terms. So of course, if you negotiate and come up with a consensus, then you guys can go in and get this purchase agreement drawn up. And what will be the third thing? The third thing is going to be a down payment. And like I said, the buyer might be required to make a down payment as well as they might not. It just depends on what you guys negotiated and came up with. So if you are required to pay a down payment, of course, then you will have to pay this down payment, right? Remember, the buyer might just not be qualified due to their credit score or due to their credit, or might be because some people have cash, and maybe just because they couldn't prove where all this cash is coming from, the lenders or the mortgage companies or the banks are not ready to give them because of course they always want to know where your money is coming from, right? So might be somebody gives you, a family member can give you this down payment, or friend, might be friends or somewhere, they can give you these down payments to pay for it. So if they ask for a down payment, then of course you are going to be required to actually make a down payment on that house. Okay. Number four is going to be the financing payment. Just like a regular person who actually goes in to take a loan from the bank to buy a house and make payments on that mortgage, you're actually going to be making those payments directly to the seller, which is your lender. So these financing payments are going to actually be agreed upon, right? When the lenders give you this money, they tell you how much you're going to be paying them every month, right? It does the same thing. You're going to actually know how much you're going to be paying the seller, so you can actually make payments on this property and soon become the owner. Okay, so these payments include both the principal and the interest. Remember I said whatever it was agreed upon, the interest rate, because if the seller tells you what interest rate they want to go for and you agree to it, and then you guys are going to go out for it, right? So just make sure you have all this put down and know how much at the end of the day you're going to be paying to the seller every month. Okay, and then title and ownership. When it comes to owner financing, one thing the buyer should keep in mind is the buyer, while making payments, they don't actually retain the title of this property. I repeat, the seller would typically retain the title of the property. So you as the buyer, as long as you're still making payments, you do not retain the title of this property. So once you complete, or you the buyer completes payments, then you can actually receive the title and full ownership, and it's going to be transferred to you. So if you haven't finished making payments on this properties to the seller, then you're eventually not going to become the whole full owner, and you're not going to receive the title from the seller. All right, so keep that in mind. And then number six could be a deed transfer. Number six could be a deed transfer, right? So some owner financing agreements use a contract for deed, and this is just basically the seller keeps this deed, just like the title, right? It depends where you're buying the house from. So just like the deed, the title, the seller actually keeps this deed until the buyer pays off the loan as well. So it's alternatively, in some cases, a separate mortgage or trust deed is created. So this mortgage or trust deed is created is just to make sure that they give you something that can prove that you actually are making payments towards this property and you're becoming the owner. However, you're still not going to have the original transfer to you as the full owner or the only owner of that house until you finish making the payments, right? So just know that this could just be to make sure that you have some ownership kind of in it, right? But it doesn't mean that you fully own that house until you finish paying for it. And the last thing you want to think about it before getting into owner financing is, what is the risk? What happens if I default as the buyer? All right, so if a buyer defaults on the owner financing agreement by not making all the payments agreed upon, the seller can potentially do what is called foreclosure. Just like the bank will foreclose on you, the seller, which is going to be your lender, remember, can equally foreclose on you. But however, the method in which they're going to use to do this foreclosure, it depends on what you guys had written in that agreement. Okay, so the process may differ depending on the specific terms outlined in the agreement. But however, if you the buyer are not able to pay all those monthly payments, Just like the bank will not let you stay forever without finishing their payments, right? They're still gonna foreclose on you because they are automatically your lender. So they can go for foreclosure, and that way they are able to gain back their house if you are unable to actually do those monthly payments. Because however, if you were doing those monthly payments to a bank and at some point you're unable to do them, and maybe they'll give you a duration, like maybe some time, and maybe if you're unable to pay, then how can they get back? If they can't get the money, then they can get the property, right? So they could foreclose on you. And that's just something that you need to know, that the seller, which is going to be, or which is automatically your lender, can actually foreclose on you. So those are some of the things. That is typically how it works, okay? But however, if you finish paying all the monthly payments and everything that is requested, then you automatically become the owner at the end of paying everything in full, right? So keep that in mind, okay? So it could be attractive if you're unable to qualify, like I said, as a buyer. But however, make sure you read the terms and conditions of this contract before you actually agree onto them and go ahead to write this purchase agreement. All right, so make sure you do your research and ask those who you need to ask as professionals to help you out in case you don't understand some of these things. Please be reminded that my videos are only for educational purposes only. Do your own research before you go out there to think of these different alternatives of becoming a homeowner if you are unable to qualify for a traditional mortgage. Please do not forget to share, like, subscribe if you haven't done so, and leave comments if you want me to talk about something in particular. Until next time, stay safe and healthy. Thank you.